Is this rate thing that much of a concern?
I think it's a significant concern in the short term. I had been on earlier this year saying that once the debt ceiling was finished, we would go back probably to the 4,400 area on the S&P. It ended sooner than we thought because the government almost ran out of money sooner than I thought. But we still got that move to 4,400, and then it overshot by a couple of hundred points. So now in the last month, it's corrected back down to that 4,400 area. The big concern has been this rise in bond yields. And that rise is concerning to me because people bought bonds earlier this year when banks started going out of business and depositors were taking their money out of banks. People bought Treasury bonds. The activity in Treasury bonds this spring was enormous. The 10-year yield fell down to about a 330. Then the Treasury Department earlier this month said they're going to issue a tremendous amount of debt to boost their cash balance, partly because of the government shutdown that's coming and partly because of 2025's debt ceiling battle. So that was a big shock to the market. Yields went up, and we've gone from a 330 to a 430. At a time when people bought a lot of it at 330, they're looking at losses and perhaps margin calls. That's why I think this has a little more to go on the correction side.
It's interesting, Dom. The other thing that caught my attention this morning is a little bit of the trading action in Schwab specifically, but the regional banks more broadly. And so the KRE is down almost 3% right now. Schwab's down about 5%, some cost cutting, maybe some other moves to kind of shore things up over there. But you wonder, again, if this is telling us the pressure on these banks from rising rates, another part of, piece of this puzzle, it's still there.
So to Brian's point, what's interesting about this is it's an issuance story, right? Also, you talk about issuance for the U.S. government and trying to shore up its cash positions heading into an uncertain time in the fall. Schwab, if these reports are true and they are raising cash through a bond issuance, are shoring up their cash positions as well. You couple that with a shrinking real estate footprint and job cuts that were not detailed, by the way. They just said they're going to target that $400 to $500 million in annual cost savings.
Pretty hefty, yeah.
Well, it's basically being conservative, right? Many of these banks maybe learned a little bit of a lesson earlier on this spring, and then all of a sudden now, with the market behaving the way that it is, are feeling like maybe this is a good time to batten down the hatches just a little bit more. So with Schwab, this is also a scenario where this is a bank that was caught up in the maelstrom that was that regional bank crisis, and it escaped relatively unscathed in that. There are still wounds that they're licking, and this is perhaps just a bit of a lesson on how they're going to kind of make sure that doesn't happen again.
And Brian, there's people kind of going through balance sheets trying to figure out when some of the high-cost debt people have been relying on to get through this crisis is going to come due, and they're going to face some rollover issues. Obviously, that same problem is kind of vexing corporate America. And you're just saying, look, let's not forget perhaps the retail or institutional investors who gobbled up those bonds earlier this year and are now facing losses.
They're facing losses, but they've also been sitting on their hands for 2 years. They haven't done a lot of corporate bond buying, and now with higher rates, that could attract them.
Brian, let me ask you about it this way. We'll talk in a moment about government shutdown and everything, but what would you say then is for you expected with stocks for the remainder of this year? That we're heading in a down range? I mean, it's like you said, you thought maybe the last 5% was the start of a 10% down move.
Yeah, well, I think this correction has a little bit more to go because of how many people bought bonds at low yields and are now facing high yields and potentially margin calls in treasuries. But the good news is that the issuance is going to stop relatively soon. The Treasury has indicated they want to boost their reserves by about $400 billion between now and the end of December, but most of that's going to come in September. So I think we're closer to the end of this issuance panic than we are to the beginning of it.
And if we're closer to the end of the issuance panic, what does that mean for stocks, do you think?
I think that after a correction, I think they go back up because I think companies are going to issue more debt. Investors are going to buy that debt, and companies are going to use that money to buy back stock. Especially if we have more of a correction in the next month or so, I think that'll make stocks attractive to companies themselves.
Yeah, Dom?
What's curious as a market watcher who's kind of going to be reporting on this, one of the things that will fascinate me more than anything else, if that scenario were to happen and we see a dipper pullback and then kind of this reemergence from that, is what the leadership will be. We know what the laggards were last year. It was tech that got crushed. It was comm services that got crushed, discretionary that got crushed. And maybe intuitively, if there was a rebound like we saw this year, it's those sectors that are leading the way out. But the Magnificent Seven did a lot of the work, the bulk of it right now. The question becomes whether or not you see any kind of a rotation in leadership. We're already starting to see some initial transitionary moves in things like energy, for instance. Is that going to emerge again as one of those leadership groups? It's not nearly as important or significant to the broader market narrative, but it could be very telling if you start to see value-type sectors and industries start to outperform again versus the same old Meta platforms and Apple and Microsoft and NVIDIA and everything AI-oriented.
Brian, care to venture a prediction?
Well, there's another sector to look at, and that's the companies that are doing the most buybacks. Stocks of those companies really underperformed, starting with the bank crisis in March. Now they're starting to gain a little bit of momentum. And I think if we start the buyback machine back up after Labor Day, which I think we will, I think those are the names that are going to be most likely to outperform.